Okay, so here's chapter 8's guided assignment. What they're trying to do on this assignment is sort of get us, or this problem is to get us to compare the direct write-off method with an allowance-based method. Okay, and so a couple of things going on with it that will be like super obvious and easy, and then a couple that are less so. And like full disclosure, I haven't worked all the way through it. I usually try to work it out ahead of time, but I dilly-dallied a little bit this morning and I didn't get all the way through. So if I make a mistake at the end, don't judge me. And if you do judge me, I don't know. That's okay, I guess, because I'll be fine. It won't really hurt me that much. Anyway, so let's see. This is entries for bad debt expense under the direct write-off and allowance method. The following selected transactions were taken from the records of Rustic Tables Company. I wonder if they make rustic tables. Just a guess. Anyway, Rustic Tables Company for the year end. Okay, so there's these transactions, and then it wants us to do a journal entry, and if no entry is required, select no entry and leave the amount boxes blank. Okay, so our first one is on June 8th. They wrote off an account of Kathy Quantel. So right now we're doing, we're journalizing these transactions under the direct write-off method. Okay, so under the direct write-off method, when we write off a debt, we're just going to debit bad debt expense, and we're going to credit our accounts receivable account. That's a direct write-off. It's an expense for the amount we're not going to collect. So we were supposed to collect $8,050 from this person. Your numbers may vary. Okay. August 14th, we received $5,720 as a partial payment on the $14,410 account of Rosalie Oaks, and we wrote off the remaining balance. So here we have a customer making a partial payment to us, and we've probably agreed with them, hey, if you can pay me this much, I'll write off the rest. Okay. So if the customer is paying us, we're going to have a debit to cash. And then a debit to bad debt expense for the amount they're not paying us. And then we're going to credit their entire accounts receivable amount. Okay, so in this case with Rosalie, she paid $5,720 in cash. So our cash goes up, or is debited $5,720. Our bad debt expense, well, let's look at, so we know that her account was $14,410. So the amount that we're going to write off as a bad debt expense is the difference between how much she owed and how much she paid, right? So I'll say 14,410, the amount she owed, minus 5,720, the amount she paid. So the difference for me is 8,690 in bad debt expense. If I start to move forward and you're feeling like either lost or like you don't understand what I just explained, please speak up, okay? We have a pandemic of sorts in the world right now of people who are afraid to speak up unless it's like on social media where they can speak up without anybody challenging them, right? This happens like every time I'm in a meeting and I speak up and say something about something that we think is a problem here at the college, and then nobody else backs me up. And so administration says, that's just you being that way. And then after the meeting, 10 people come up to me and say, man, you said exactly how I feel in my heart. And I'm like, yeah, but the bosses don't think it's a problem because nobody else spoke up, right? So speak up. Power of the people. All right. It happens to me all the time. Man, I really love how you said that. You're like, well, freaking back me up then, dude. Don't leave me out there hanging. The bosses are like, does anybody else feel this way? And it's like, no, but I'll complain about it on social media. All right. October 16th, received $8,050 from Kathy Quantel, whose account had been written off on June 8th. So we have to reinstate the account and then record the cash receipt. So you're like, awesome. So apparently after we wrote off her account, Kathy got the money and decided to pay us. So the first thing to reinstate it is just going to be the reverse of the write-off entry we did on June 8th. So we're going to debit accounts receivable. Her accounts receivable goes back up. And we're going to credit bad debt expense. Bad debt expense goes down because it's no longer going to be a bad debt, and it's no longer going to be, and she's going to owe us again. And that's the amount, 8,050 for me. Then we record the payment, which is our cash going up and the accounts receivable going down. Again, by the same amount. So all we're really doing is saying that debt we wrote off, we're unwriting it off, putting it back in there as an account receivable and taking away the debt expense, bad debt expense, and then showing that we received the cash and the debt went away. The way debt should go away, by someone paying them off. Unless President Biden tells me I don't have to pay my student loans back, and then I'll be like, I won't complain. You guys know that a lot of your college teachers probably have student loans, student debt, because they had to go to lots of college. It's just part of it. It was a good investment for me to spend $30,000 to have a job I like that pays well, right? All right, on December 31st, we wrote off the following accounts as uncollectible. So whenever we write off accounts using the direct write-off method, we're debiting bad debt expense, and then we're crediting accounts receivable for each of those accounts. So I have Wade Dolan's account, 2330. Greg Gagney. Oh, accounts receivable, good catch. They tried to trick me and they nearly did, but thankfully you got my back. All right, accounts receivable. For Greg Gagney was 1450 on mine. Amber Kisco. Not Cusco, that'd be cooler. That's one of the best Disney movies ever made. You could disagree with me if you want. I mean, it's no Coco. Shannon Poole. The thing with Coco is it wrecks you still. Like I cry every time I watch it. If you don't, it's because you're a heartless wretch. So don't scoff. Okay. Or maybe it's because you don't really, have, if something happens to you when you have grandkids and you just like connect with them, and then you're like, wait a minute, there's probably people that are dead right now that love me the same way I love this little girl, like that. And then Coco just wrecks you. And then you're like singing Remember Me in the shower and cry. Okay. Maybe that doesn't happen to you someday though. All right. And the last one is Nikki Spence. I'm not sure how I feel about the name Nikki Spence. Sounds like an action star. Nikki Spence. So dense? Oh, intense is better. Nikki Spence is so dense. Okay, we're gonna add all those up. And that'll be the amount of our bad debt expense. So what we're really saying here is we're taking the expense for all of these different accounts receivable amounts that we don't think we're going to owe. I mean, collect. We're not going to be able to collect them from somebody. And then by crediting the accounts receivable, we're actually wiping out those debts. So we're telling these people, you don't have to pay us anymore. We're probably not telling them that. We're probably just saying we don't think we're going to get paid for this. I wouldn't send them a letter saying like, you don't have to pay me now, in case because they should still pay me, but we don't believe they're going to pay us. Yeah. You can. Yeah, you can. But if someone doesn't have any money, now you spend money for court fees only to, find someone who, like, maybe the court will put them on like a forced payment plan for $50 a month or something like that, because that's all they can afford. And so a lot of times it just doesn't pay to take legal action. It's expensive to sue somebody. Yeah, that's usually what I mean, you try to collect it, right? And you can also, there are companies that you can sell your bad debts to, believe it or not, that they'll buy them like maybe like this $13,000, they'll pay you something like 10%, they'll pay you $1,344, and then they now own the rights to that debt. And if they can collect more than 1,300, then they make money. They're called a factoring company, or well, that's one of the things factors do. They do other things too, but in essence, they buy out people's debt and then they try to collect it, or a collection agency. Sometimes that you've heard of those, right? So, if you're good at collecting, then you can start a company where that's what you do. You go and you buy people's accounts receivable that they don't think they're going to collect on for a steep discount, and then you try to collect it. A lot of times we would do, like, for our business, we would do like a partial amnesty right around tax return time. So we would say, like, if somebody owed us $1,000, we'd go out and say, like, we'll settle your account for 50%. So if you can pay us 500, we'll wipe out the whole 1,000 you owe us. Right when we knew they were getting tax returns where they would have some cash. And so that, I mean, there's some strategies you can do to try to collect more of it. Because I figured half of it was better than the nothing I was gonna get. So I was trying to induce them to pay it. All right. All right, last one, December 31st. If necessary, record a year-end adjusting entry for uncollectible accounts. So in this case, when we do the direct write-off method, there's no adjusting entry. That's the thing with it, right? We just write off the debts as we think we can't receive them. And so the problem with that is, again, we might be making adjustments and claiming an expense for something where the revenue was in a previous period or something like that. So that's the challenge with doing the direct write-off method. So there's going to be no entry required. Now, I've been doing a lot of extra talking, so the chances that I made an error are relatively high. So I'm going to check my work. Let's see how we did. Never doubt me, children. Never doubt me. I choose to doubt my doubts, not to doubt my accounting. I say that now and we'll probably suck on the next one. Stink, because suck's not nice. My grandmother did not appreciate when I would say that as a teenager. Like, that sucks. And my grandma would be like, cringe. All right. But now the new generation of grandparents says suck all the time because it's me, right? You keep thinking I should be nice like my grandma was, and then there's another part of you that's like, nah. So I just made a little snip of my of that information from up top, so that I don't have to keep scrolling, because this second part down here, it's pretty much the same stuff. So it says journalize the transactions under the allowance method, assuming that the allowance account has a beginning balance of 24,150 at the beginning of the year. When else would you have a beginning balance? Cengage. And the company uses the analysis of receivables method. Okay, so here it gives us this aging schedule, and then right now we're supposed to do these journal entries. These journal entries are going to be eerily similar to the ones we just made, except for instead of writing things off to bad debt expense like we did up above, we're now going to write things off to the allowance for doubtful accounts. So when we decide someone can't pay us, we're going to debit the allowance for doubtful accounts, and we're going to credit the accounts receivable account. So this first one is right here. We wrote off the account of Kathy Quantel, $8,050. So the only difference between this and the direct write-off method is we debited the allowance for doubtful accounts instead of debiting bad debt expense, right? Because what we do is at the end of each year, we do an adjustment that will take the full expense for the year and then credit the allowance account. And then throughout the year, we will write off any debts that we can't collect to the allowance. That's the difference between the two, okay? So on August 14th, we received this partial payment of $5,720. So again, I'm going to debit my cash, the amount I collected. I'm going to credit, instead of bad debt expense, the allowance for doubtful accounts. And then I'm going to debit that, and then I'm going to credit my accounts receivable. And again, we know that we owed her $14,410. Or I'm sorry, she owed us $14,410. These are receivables. So the difference between that 14,410 and 5720 is the amount we're writing off. And I can just scroll up and see, because I did it up above, 8,690. Maybe you probably figured this out already, but when in doubt, make your journal entry balance, make your debits and credits balance, and you'll have the numbers right at least. Does that make sense? So in this case, we knew we received a certain amount of cash, so we debit cash, and we knew that that the whole account was going away. So we knew that 14,410. So if we just make it balance, find the difference between the two, then we know the amount that we're going to be charging to the allowance, the amount we're writing off. So when in doubt, just make a balance, and then it sometimes helps you figure out what accounts you should be dealing with. On October 16th, we received $8,050 from Kathy again. So again, the first thing we have to do is reinstate the account. So that's going to be the reverse of our June 8th where we wrote it off. So we're going to debit accounts receivable to make that account go back up. And we're going to credit allowance for doubtful accounts. So now we've removed that write-off, right? And now we're going to record the payment of it. So our cash will go up and our accounts receivable will go down. On December 31st, we write off all these accounts as uncollectible. Again, when we did the direct write-off method up here, all we did was debit bad debt expense and then credit all of those accounts receivable accounts. Well, here we're just going to debit the allowance for doubtful accounts and then credit all of those accounts receivable accounts. I could add them all up again, or I could scroll up and see what I put up here. Total was 13,440. All right. I'll wait a moment and let you guys catch up. I'm going to check my work. At which point I realize I have a 93% and I could say screw it to the rest of the problem because I got an A. Or I could strive for excellence, right? Yeah, I'm all about striving for excellence. So this last one's going to be kind of hard. In fact, so hard that right? Oh, really? He wants no entry in both lines? Good to know, my friend. So up here, pow, I'll get more points for doing that. Oh, yeah. Always, you're like a Bitcoin miner. You're a point miner. I'm going to get an extra 0.8%. Making money out of nothing. Except it doesn't really make money out of nothing, right? Apparently Bitcoin mining takes huge amounts of electricity, and then everybody's like, it's socially irresponsible. And I'm like, compared to like strip mining, I don't know. Seems reasonable. I could do solar at least for my electrical. I don't know. I'm not saying I have a Bitcoining operation going on because I'm not smart enough. If I could get rich by doing nothing, I would do it. But instead, I have to get rich by doing something, which seems kind of lame. All right. It's kind of the American way, though. All right. Anyway, so in this case, my allowance for doubtful accounts has a beginning balance of $24,150. So I'm going to just create a little T account here. I'm going to call it allowance. Okay. And then I'm going to say it had a beginning balance of $24,150. Throughout the year, I've done some actual write-offs on it, right? So what I'm going to do is I'm just going to enter all these journal entries now. So on June 8th, I debited that account, $8,050. And then on August 14th, I debited the account $8,690. And then on August 16th, I credited the account $8,050. That's when I reversed that write-off, right? And then on December 31st, I debited the account $13,000. So those are all the transactions that occurred in the allowance for doubtful accounts account during the year. So to find my new balance, I'll say this equals that plus that minus that minus that minus that. So at the end of the year, I have a balance of $2,020 in my allowance for doubtful accounts account. And so now I've got to make some kind of a journal entry to bring it up to where it should be. So here's how I figure out where it should be. So I have all of these debts, okay? And so the first category, the 0 to 30 days. So again, these aren't my debts, these are debts owed to me, okay? So I have 386,000, and I estimate that 2% is uncollectible. You see where I'm seeing this at in this little table? 386,000, 2% of which is uncollectible. I have 145,000 that I estimate 7% is uncollectible. I have 46,000 that I estimate 20% is uncollectible. 17,000 that I estimate 45% is uncollectible. And I have 23,000 that I estimate 85% as uncollectible. Where do those estimates come from? Past experience. Okay, so in real life, you would just have to sort of figure that out. Say, okay, in the past 5 years, when things get older than 120 days, what percentage of those do we actually end up collecting? And that's what they set that on, okay? So to figure out how much, I'm just going to multiply it, 386,000 times 2%. And I'm going to do that calculation all the way down and then add them all up. So I think that I'm not going to be able to collect $54,270 of the total of $617,000 that's owed to me. Does that make sense? So now the question is, what journal entry do I need to create to bring the balance of my allowance for doubtful accounts account up to $54,270? Right, so I already have a balance of 2020 in there. So I'm going to have to credit that account 54,270 minus 2020. I'm going to have to credit that account $52,250 in order to bring the balance of that account up to the amount I think I'm not going to collect, which is 54,270. That's a little, like I said, that's a little complicated. So my journal entry will look like this: bad debt expense and allowance for doubtful accounts. And mine's going to be 52,250. Yeah, we should do that. How much higher would or lower would Rustic Table's net income have been under the direct write-off method than under the allowance method? So recognize that revenue doesn't change regardless of the method we use. So the only thing that's going to change is the expense, and that's what's going to dictate the difference in our net income. So if we scroll up and look first at the direct write-off method, in essence, I can just try to figure out the total amount of expense I took. Okay, so under the direct write-off method, I had a bad debt expense of 8,050, a bad debt expense of 8,690, and then I removed that 8,050, right? So I'm going to do a negative expense, but because I credited expense, I guess I could do it that way too. I could do it as a journal entry. So I debited the expense of 8,050, debited the expense 8,690, credited 8,050, and then debited 13,440. So under the direct write-off method, my total expense for the year was 22,130. Under the allowance method, you'll see that I never took an expense anywhere in here, right? So my only expense was right here, a debit of 52,250. So remember that an expense has the impact of lowering my net income, right? So we would say, what did the question ask us? It says, how much higher or lower would Rustic Table's net income have been under the direct write-off method than under the allowance method? So under the direct write-off method, since there was less expense, the net income would be higher. And by how much? Well, the difference between the two. 52,250 minus 22,130. Hooray, I got it. Scroll up where? To where?